Welcome back to Invest with Tanya. Today we're bringing back a very special guest, Laura Andrade. And if you missed her last video, I'm going to be linking it up here so that way you guys can watch it and see all the great nuggets that she has talked to us about in the past. Today we're back with amazing things on what investors should be looking for with loans. And when I mean investors, this means like you're not going to be living in the property. This means you're going to actually just buy it for the purpose of investment. Okay, Laura, so first off, what are some loans that investors should be aware of?
Hi, everyone. So in investors, it's awesome. There's there's products out there. It's just learning what the products and what they actually need to be able to qualify for those loans. First of all, the conventional is probably, I would say, the best. If they can qualify on the conventional loan, it would be the best product. Let me tell you why. It's because interest rates on investment properties are already higher typically than a primary property. So that's something that also investors need to know. Interest rates on investment properties are typically higher. So that's totally normal. It's not because of anything. So if they're already higher, any other type of difference of products or non-QM loans that I'm going to talk about a little bit later, then that would be a little bit more higher interest rate. So conventional loan is the best product. You can do anywhere from 20% down payment. And if you have a credit score, the better credit score, the better interest rate. So it is an investment property. You can do 1 to 2 units. When I say 1 to 2 units, 1 unit is a single dwelling home. 2 units or more, it's a duplex or 2 to 4 unit property. So I don't know how far I was able to hear, but typically the basic on the conventional loan is the best product for investors. And the only reason is it's a little bit more of a comfortable interest rate. I would say it that way just because investing properties are typically higher in interest rates. In conventional loan, if you're able to qualify in a conventional loan with the down payment and the credit score, that's the way to go. I would just go there just because it's a good product. From there, you can do anywhere from 1 unit to 4 units. So it's whenever we talk about units, as if it's a single dwelling or duplex or more units, it's just really depending on the investor, what they're looking for to invest in. But typically that would be like my number one program. If the people can qualify on that, that's, I would say, in my personal view, the perfect loan.
Okay, and is there another loan that you could talk to us about?
Yes, I actually have 2 more. And the other one is actually, they call it the DSCR. Then DSCR loan. So typically this loan is when investors have too much debt on their, on their books, they can't qualify on a conventional with their DTI ratios, then we can look at this loan. This type of loan, now interest rate would be a little bit higher, and normally we can go more in detail now whenever a customer wants to apply, and depending on their credit score, everything on that, it entails and what interest rate would be. But on a DSCR, we typically divide the rental income divided by the PITIA, which is the principal interest, all those for the property that they're buying. So the rental that they're going to buy, they're going to rent it for, we divide it by that. And then depending on that number, it depends on their credit score and to see what percentage we're able to do. So it's a little bit more complicated to understand, but it's just the basic information for customers to understand is we do not look at the regular debt to income ratios that we typically do on a conventional. We look at more of the rental income and just focus on that property. Now, depending on the credit score, it also depends on the down payment. It could go anywhere from 20 to 30% down payment, but it's a good product for investors. Typically, investors have some equity or income to be able to do that kind of payment, down payment. So that's another option for them, which is a really good program. And then I want to move to the renovation loans. which the renovation loan is basically we can do an investment property on that as well. And this one can also be for primary property. It doesn't have to be just an investment, but sometimes the investor wants to purchase a property that there's still work to be done. And in that case, we can do a renovation loan. And then how the renovation loan works, and I think Tanya, you have one of those. Perfect. So it kind of gives you a little scenario and how we look at things. So let's say that the property was purchased for $75,000 as is. The cost for the improvements will probably be around 180,000. And then so the total of the property will equal out to 255. We have to be a completed value of the property of 250. We cannot do the maximum allowed for the renovation cost is 75%. So this kind of explains a little bit in how the maximum renovation is 75% that we can allow to do. So I showed that math to kind of explain a little bit because it's sometimes very difficult to explain just by saying it, especially with loan terms and all that. But this is another awesome product that investors should also know about in case they're looking for a house to invest in. Also, one of the things about this type of product is the investor, the person who is fixing the renovation has to be a builder certified. So it has to be someone that's certified to build, to fix all these, which is a builder.
And do interest rates change on this type of loan compared to like a conventional loan?
It is. It is also typically we want the renovations to be completed within 6 months. So it is something that we do look at a fixed rate, but then it just really depends how those renovations kind of complete. So our major thing is for it to be completed within 6 months and work with the customer. So it could change difference if it doesn't meet those guidelines.
Okay, perfect. And then I guess, so my last question is really like, what advice would you give to a smaller investor that's looking to start investing in this?
I would typically advise them for those investors that are trying to invest nowadays, which is really good opportunity for them, is to start taking care of that credit score. The reason I say that is just, and I emphasize it a lot all this time that I've been talking about the products, is the better credit score, the better interest rate you'll get in all amount, even a primary or investing. But like I said, investment properties are typically higher in interest. So the better the credit score, the better you would go off. And some of these products that I went over, sometimes depending on your credit score, it will allow you to do a lower down payment, maybe a 20% down payment instead of a 30% down payment. So the credit score would be something that I would also recommend. Also savings, save for that down payment. So there's not really any program out there that helps with the down, kind of like what we look at the primary properties, down payment assistance. There's really not much out there where we can do a down payment assistance for an investment property. So that's something else that we have to take in consideration, is to kind of save that savings to be able to put down for the investment property. Another thing that I put on there, I think on the questions that you said, is be a homeowner. Try to get indulged in all that information. Trying to get what is a house, what is a principal, what is interest, what is escrow, what is all this. There's so much information out there. Work close with the lender. Something that I enjoy teaching and talking to. I have clients that I've been working with them for a year and we're still not ready, but they're learning the process. They're learning what do they need. What is it? What is a homeowner's insurance? What is HOA dues? There's so much information on a mortgage. And I think that as an investor, you kind of need to get that information to understand how it works and all that stuff. So work with a close lender that's willing to work with you. And sometimes in a long process, sometimes in a short, process, depending where you're at, have the lender meet you there and work with you, and have those plans be able to expand. Like I said, I have clients that we're having them for next year that they'll buy a house. But that's what I enjoy about my job, that I like to walk with them at their speed whenever they're ready. And when they're ready, then they'll get that house in basically that investment property, it depending on what they're looking for.
Okay, well, perfect. And there was one question that I did forget to ask you. Um, and I think you said this, but you got cut out. So this is for only units that have like 1 to 4 houses, right?
So it depends. To conventional, yes, 1 to 4 unit. Mhm.
Okay.
Yeah.
Okay. And then, oh, sorry. And then is there like a program where you can put less than 20% down as an investor?
Yes, actually, conventional, you can do a 15% down payment as an investment property. So, which is really good. It's just, it does have some specifications like any other program, and we can go more in detail, but typically you want to have a 700 credit score above to try to get that, not get the mortgage insurance and stuff like that. But we've been able to do 15% on investment property for a conventional loan. So that's one of the benefits of getting that credit score good and the down payment. And honestly, 5% from a 20 to a 5%, it's a big difference.
It is. It is. And then the rates just went down, right? That's what I was looking at.
Yes. So in the last couple weeks, week and a half or so, we've seen those rates come down, which is awesome because we've been struggling with those rates rising last year. And that's something really good that customers are able to see. And we're hoping that they will come down. We don't know the future, what happens, what will entail, but having that little positivity coming our way and seeing those rates down, I think it kind of helps our clients, and it helps get them qualified for some more probably amounts or anything like that, and gives them a little bit more of a perspective. And also the people they closed last year with those high rates, they can also refinance, which is perfect, and seeing how if it's beneficial or not. So people who've bought in with those high rates, it's just keep a watch on it to see how much it will come down, and just for them to know that there's a possibility to refinance, because sometimes people think they have to wait the whole 30 years or the whole 15 years, and they don't have that opportunity. So again, work with the lender and see if that's something that benefits you now, or it should wait a little bit longer and to see the refinance.
Okay, well, perfect. As always, Laura, thank you so much for coming on. I really enjoy your expertise on this, and I hope that we get to do a few more of these.
Yes, of course. Thank you for having me here, Tanya. And again, if any questions come up, let me know. I'm more than happy to answer them.
Okay, well, perfect. Thank you so much, and we'll talk
Thank you.
later.
See ya.